This video is all about using the market regimes system inside the perfect momentum strategy. Now, what market regimes are, they are quantifiable ways for us to detect different types of market environments. For example, we can detect bull markets, we can detect bear markets, we can detect sideways ranging markets, and we can choose whether to take trades or what type of trades to even take within those type of environments. That's why market regimes is so special and important. So what we use inside of all of our Zen trading strategy systems, and what we're using here in the perfect momentum strategy, is this market regime type built and based upon Dr. Van Tharp's SQN analysis. SQN and market regime are the same thing. So these numbers here, so for example, any market regime number less than negative 0.6 will be classified as a bear volatile market. Any market regime number between 0 and negative 0.6 is a bear quiet. These two numbers are for a neutral sideways or ranging market. And your bull markets are going to be 0.75 to 1.47. They're more quiet bullish. And the very volatile, extremely bullish markets are any market regimes greater than 1.47. So going to our strategy now and looking at the market regime section. Let's scroll down to that. Okay, let me take this off for a second. So what we've done first is, say we're just in the middle of creating a strategy, and let's say that we want to look for any time stochastic momentum goes beneath 1 to go long, and exit it anytime it goes above 99. And now let's say we want to maybe specify a couple filters or conditions for that based on market regimes. Let's say we want to find these entries and exits when on the short term it's bearish, so we can get maybe some really good entries, but we still want it to be bullish in the longer term in the higher settings. So we can go over to our market regime settings and we can look for those conditions. So we have 1, 2, 3 market regime filters for longs, and we have 1, 2, 3 market regime filters for shorts. So you can use one as maybe a short time frame, middle time frame, and the third one as a long time frame. So you can control your shorts and longs separately if you're in a system that trades both at the same time, or maybe you're just trading a short system. You have all the flexibility and power to make any kind of condition you want. Now in this example, where we're going back to the stochastics and looking for a bearish short-term condition and a bullish long-term condition, I could click on Use the Market Regime Filter Long, and we're on the hour chart, so this is going to use hour settings. I'm going to use it as the same period as my stochastic setting. We have a 24 look back, so I'm going to decide just to use the same look back period here. You can change this however you want. You don't have to use the same exact thing, but you can. And here, bullish, any bear conditions are below -6. So I'm just going to input that as the maximum I can look for, and the minimum I can look for, I'm going to put just a more bearish number. And let's take a look what happens now. So if I start looking for this condition, okay, little less profit, but it has a better drawdown and a better profit factor. And I believe it was a tad bit more profitable per trade. Okay, around the same thing. Now if we stack that second condition, we're going to look for this in bullish conditions. We got a lot more specific. Now we're taking less trades, so our profit is down a little bit, but we got more profitable. Our profit factor almost doubled, and our drawdown went way down. So again, you could use this for looking for very specific conditions based on market regime. I would recommend just studying this or just referencing it when you're creating your systems to look for specific market conditions. And you can use these to find and set any market regime you're looking for on any time frame, and use them all with each other. Now you can use these market regimes with any oscillator on here, any RSI, any stochastic, anything you want. You can use them all together at the same time. It's a great way to filter these via market regime. So another thing you have too here is the market regime cross as a filter. Let me explain that real quick and show you what that does. So if I'm going to add 2 moving averages to the market regime. So we're going to add moving average, 2 exponential moving averages. And this market regime is a 24, so I'm going to make a fast and a slow. And this is just to demonstrate what's actually how this works. Okay. I'm going to make my slow one a 12, which is going to be half the time period we're looking here on the market regime. Move this to the back. Let's change my colors real quick. So we're going to make the slow one a yellow color. Make it nice and thick. And we'll make the fast one a bright blue, and we'll make that nice and thick. And we'll make it a little thinner so we can see when it crosses over. Okay. So what you can do with these market regime moving average crosses, let me go back to them. So right now we're looking for bearish conditions. We're looking for a negative 0.6 to 2. But if we want to find that when market regime is falling instead of rising, so for example here, our 0.6 where we're entering in, that could be here, or that could be here, but you'll see here price is rising because market regime is rising. So we actually want to catch it on this side. We want to catch it when market regime is falling. So if we get it when the fast moving average is crossing beneath the slow moving average, we can be on the right side of the market regime. And we would just go to our market regime moving average cross. Let's find that real quick. And we want the fast to be 12. I'm sorry, 1, and the slow to be 12. Now when we have that setting, we will only enter those market regimes when it is crossing beneath. And you have a market regime moving average cross for each market regime, each of the 3 of them. So you have one for this one for your long, your second long, and one for your third long, and same thing for all the shorts. So that's it for market regimes. It's a very powerful way, probably the most powerful way of filtering your trades via what's happening in the market and making sure it's very adaptive. So thanks for watching and enjoy.